Hello, everyone, and welcome to the Friday edition of your Daily Five. I'm Joe Duarte, founder of Joe Duarte and the MoneyOptions.com. And I'd like to thank everyone at StockCharts for giving me the opportunity to do this show. Today, I want to talk to you about the markets, which I consider to be at the edge of chaos and trading in the post-new normal world. And this is a world where easy money, zero negative interest rates, government bailouts, and an ongoing pandemic serve as our trading background. Yeah, that's it. Of course, we all know the markets have changed dramatically, but more importantly, those of us who trade know that adaptation is the key to survival in any market. And thankfully, we have technical analysis in StockCharts.com to help us get through these times. That's what today's charts are all about, and adapting to this post-new normal trading environment. I'd like to have a look at the first chart, and it's the New York Stock Exchange Advanced Decline line going back to the election of Donald Trump in November 2016. Now, this looks like a little busy slide, but I'm going to go through it with you, so bear with me here. We're looking at the really big picture here over the last three and a half years or so, and looking at the first cutout here, or call out, the complexity zone. This is the area of the markets where things work optimally. This is where everything goes right, and you can see in the complexity zone, there's a general uptrend to the market. This is the chaos zone, which is, of course, where things go terribly wrong if you're long the market, and that's where things are very disorderly. EOC is the edge of chaos, and if you read my articles, and of course the title of my column, then Trading at the Edge of Chaos, this is what I'm talking about. This is the 200-day moving average. That's really an area where the edge of chaos is concentrated, where complexity, the forces of the universe that make things work just right, are at their highest. So let's look at these circled areas. We see that at the beginning of the post-new normal world, after the election, we had a jump of the New York Stock Exchange Advanced Decline line above the 50-day moving average, which is the blue line. And of course, we see that all the way through to 2018, that market stayed in an uptrend. We had a little bit of a blip in February of 2018 where the line dropped below the 50-day, but it recovered because it never hit the 200-day moving average. Now it gets interesting. We look at what happened in 2018 when the Fed raised interest rates, and we saw a significant drop below the 50-day, and then 3 failed attempts to get back above that 50-day, and then a resumption of the downtrend when the 200-day moving average was breached. That's a pure entry into chaos. So what do we have now? We had the freeze up in the repo market. The Fed eased aggressively. The market had an accelerated uptrend. Then coronavirus hit, and here we go. We had 35% decline in the stock market, bear market, and the market has recovered. But then we're starting to see that at this point, it's the line is struggling above that, around that 200-day moving average. And if we look back to the prior significant decline, we saw that we had the negative divergence in the ROC and the double top in RSI. And unfortunately, we're having the same kind of situation now, as we can see here. So unless this line can cut above that 50-day moving average, we might have some problems, and I just want to make sure that everyone has been warned. Of course, things may straighten out, but we're at that decision point. Nevertheless, we're in that an unusual trading period, so we need to focus on stocks that are doing well in this market. And then, of course, we have everyone staying at home, working from home. So Akamai Technologies is a stock that could benefit from that because they have all the cloud technologies, from security to servers to management software. And so we could have this stock could do well, of course, unless the market completely tanks again, because we saw that it did so in December when that happened. But as long as it stays above that 50-day moving average and the 200-day moving average, it's in the complexity zone. You can also see that unbalanced volume is fairly good, and so is accumulation distribution. And RSI is nowhere near overbought. So Akamai's got a little bit of room to work with. Next, I want to discuss GlaxoSmithKline. This is a large pharmaceutical company that has a 4 3/4 dividend yield. You can see that it was not spared the bear market, but certainly accumulation distribution is back up. Unbalanced volume is improved. and it's back above that 200-day moving average and the 50-day moving average. So it's trading in the complexity zone. Certainly things could change, but at this point, the stock looks like it's heading in the right direction. Most importantly, as you might have noticed in the news, Gilead Sciences, which has the leading potential treatment for COVID-19, is having some troubles. And Glaxo is a leader in vaccines. It has the leadership position in shingles vaccine, very experienced companies in vaccine. And of course, it's working on a COVID-19 vaccine. So Glaxo is a stock to keep an eye on. Next, I want to look at Leidos Holdings. This is not a very well-known company, but it's in a sweet spot in the sense of it does its business with governments, and it has software for management of processes and all kinds of things that the governments need to continue to function. And so it's going to make money regardless of what happens because the governments need to run themselves. The big thing about Leidos, though, is it has some top secret stuff that goes on with the Department of Defense. And I think that's the one thing that's probably going to continue to keep money coming into Leidos. Again, accumulation distribution, fairly good, on balance volume turning up, above 200-day moving average, above 50-day moving average, which means it's in the complexity zone. Finally, here's one I want to spend a little bit of extra time on. Exxon Mobil. Oil futures recently traded in the negative number area. There are other companies now, for example, the news this morning that Continental Resources has shut down its fracking operations in South Dakota and is going to stop shipping oil to its customers. Meanwhile, Exxon continues to rise, which is interesting. Now it's at that 50-day moving average. And we can look at a little bit of shrinkage in the Bollinger Bands, these green bands, which tells us that some kind of big move is coming. Furthermore, it's above the 20-day moving average, and it's starting to test the 50-day moving average. On the downside, we have accumulation distribution that does not look very appealing, but on balance volume that is trying to work its way back up. So it looks like a little bit of money's working its way into Exxon, and nobody is really selling it off right now. So furthermore, I like this ascending triangle that I'm seeing here. Drilling down a little more, and we see that RSI is just above 50, which means it's not overbought and it has room to rise. So in summary, we are in a post-new normal world. We're at the edge of chaos. And if the New York Stock Exchange advanced decline line can manage to rise above its 50-day moving average, that would be very encouraging and would give us a little bit of an all clear in order to stay long this market. Furthermore, if you focus on companies such as Leidos Holdings, GlaxoSmithKline, Akamai Technologies, and Exxon, if you're feeling a little bit speculative, you'd probably be on the right side of this market. As usual, I always recommend that you have excellent sell stops and that everything goes as planned as long as you have a good trading plan. I'm Joe Duarte. Thank you for watching my show today, and consider a free trial to my service, Joe Duarte in themoneyoptions.com. Have a great Friday.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.